Cole, let's talk energy for a second, because oil prices do have everyone's attention today, and you've got some interesting ideas about how to invest in that space. Welcome.
Yeah, thanks for having me, Kelly. The good part, if you were standing here in front of me, you'd see from my cowboy boots, is this is not my first rodeo. We had a lot of similar conversations around the idea of tariffs, or I'll call it anti-dumping duties, in 2016 when Trump came to power with softwood lumber. And they refer to that as the softwood lumber dispute that happened back then. And stock markets are highly elastic. The only problem is commodity markets are highly inelastic. And so these movements are being priced into securities markets immediately. For example, 2 days ago, you could find names like Cenovus or Meg Energy or Strathcona up in Canada that moved off this news to the idea of tariffs on Canadian oil. At the same time, how commodity markets react is they just reduce supply, and that takes time. The problem is once you reduce supply because of lower prices from tariffs, it doesn't come back immediately. So we think this causes a big supply issue in the long run, though.
And I think what you're saying is really interesting, Cole, as we're heading into this Trump 2.0. You're basically saying the tariffs that we launched against Canada on lumber in 2016 made prices higher for us and benefited Canadian producers like West Fraser. So where would you be investing now if you wanted to take advantage of what you thought might be similar movements on a larger scale this time around?
Yeah, I think the general principle you should always follow as an investor is don't look where things look the greatest. Look where things look the worst. So, for example, the oil market ending last year looked pretty weak to people. People were pretty scared of it in general. Then you walk into this year and you slap on the idea of tariffing Canadian oil. Well, that looks pretty miserable, Kelly. And for us, Kelly, that's like a dream. You're getting just as negative sentiment. People don't want to touch the stocks. And the reality is it's really tough to change supply. So to your point on lumber, you know, we went on to the market swallowed what ended up being over 30% tariffs. They swallowed that. How? Prices went higher. If you go look at from 2016 to 2020, I mean, prices were well above where they started at during that tariff discussion.
Absolutely.
It ended up going into the profits and the free cash flow of those Canadian producers. So we still own West Fraser. It's been a wonderful investment.
You do? Interesting. Okay, so you bought the Canadian lumber company. In that case, are the oil companies that you like now, then, are those Canadian names?
Correct. Yeah. So our biggest is Meg Energy. It's a single asset producer in a place called Christina Lake. They produce what they call heavy oil or heavy crude through what they call SAGD. It's where you literally steam up, the tar and you get oil out of it. So that's a pretty common process up there. That's the kind of oil we're talking about. It's not light sweet crude like we have in the Permian. The other name we own there is Strathcona. Again, independent producer. The majors, like the Canadian majors, like an Imperial who we own or Cenovus, they're a little less affected because they refine. So if the spreads blow out between WTI and Western Canada Select Oil, those refiners get to buy that oil cheaper. And if gasoline prices don't get tariffed, they're going to collect more margin. So, again, this is all we're all right now under the heading of if you say it, it's like Christ said it. It becomes red letter version of the King James. The problem is what actually will play out could be different.
Yeah.
We love how people are leaving the securities because the idea of Trump and anything he says, it's like sugar and spice and everything nice. It just sounds wonderful right now. The question is what will actually happen. Security markets are moving far quicker than these commodity markets are.
What do you think is going to happen to the U.S. energy plays, which I know you and Bill have been, I forget which ones exactly he's mentioned it. Oxy was a big one. Obviously, that's been
Oxy
a struggle.
Still is. Yep.
So what do you think happens to the U.S. producers amid higher tariffs on Canadian oil or elsewhere?
Yeah, it's just going to be higher prices because you can't. If supply goes down coming across the border from Canada, you're going to quickly recognize that America is not producing more oil. We are flatlining oil production. Go look at the Saudis. Why are they so comfortable allowing themselves to maintain their supply? Because they do not believe Trump. They do not believe drill, baby, drill. Because Trump is not deciding who drills. It's the energy investors themselves that are deciding who drills. If you go look at an energy company that increases CapEx, you're going to watch a falling stock price. Okay, so again, the stock market is deciding very quickly whether we're going to drill or not. They're voting resoundingly no.
Even with
but
rising,
you're hearing very different political rhetoric.
And obviously, we saw how that drill mentality blew up kind of during the last shale cycle. But with oil prices heading higher, does that change the calculus? Does that potentially incentivize more investors and management teams to say, all right, we're looking at potentially demand growth because of tariffs. We're getting a higher oil price. Maybe this can be justified.
Yeah. Price always regulates price. Prices go higher, supply will show up. what's going on, though, is demand is just continuing to grow. Right? We are not dealing with declining demand in oil products, for example. So the question is, as we go from today to 10 years from now, there will be 10 million more barrels of demand. The question is, who will supply that? OPEC can do about 3 to 4 million. The other 5 or 6, right now, America will not be meeting that need because we will not increase our CapEx budgets. So, again, to your point, that's got to be met, and price will always cause people to produce more. $90 to $100 a barrel is where I could see OPEC saying, hey, we'll bring some supply back to the market. But right now in the American energy space, look at how the stocks did late last year, Kelly. Are you telling me the oil majors are going to come out and increase their CapEx budgets massively while investors have been selling their stock? Not a chance.
Yeah, we'll see. I know I agree with you, but it's a good way to look at the opportunities, again, from an investing point of view. It might be more north of the border than here.
Go
ahead.
I was just going to add one more thing. So look at the 10-year Treasury moving higher right now, okay? People are beginning to worry about that. We're not near the kind of a Liz Truss moment where they're freaking out about it. But it's very fun to sit here right now, Kelly, and watch the 10-year climb higher and oil climb higher, and people are losing some money, and you're just smiling ear to ear with these energy stocks. I think it's a way to get rich when circumstances are really poor for a lot of investors. But again, that's a very narrow view, but I think it's right.
Interesting. I was just going to say, Cole, I would have to see the cowboy boots to know how many rodeos you've actually been through.
Well, that means you got to come to Phoenix, and that's the offer's open, Kelly. So
I will try. Maybe in 10 years, we'll see what the oil demand picture is like. Cole, thank you very much for joining us today.